Okay, good evening, everyone, and welcome to the RSI-2 strategy session with Systematic Investors Group. Can everybody hear me and see the screen okay? If you could just drop something in the chat box. Yes to both, thank you. Awesome, thanks everyone. I recognize a lot of faces on here, and I appreciate you coming out on this sunny Thursday night. I don't even know what day it is. Sunny Thursday night to be with us. All right, so today we're going to be talking about an RSI-2 strategy implementation. And the expected meeting time is going to be about an hour. The meeting is being recorded, and this will be an educational presentation. Sales will be kept to a minimum. Of course, there's always going to be one or two slides at the end. So let's officially get started. Okay, welcome to the Systematic Investors Group RSI-2 strategy session presentation. We'll be going over the rules and backtest results of an RSI-2 strategy implementation that you can start using to get trading ideas as soon as tomorrow morning. So sorry for the disclaimers right at the start, everyone, but it needs to be said. Trading and investing can contain significant financial risks. This presentation and all references are subject to the disclaimers as posted on our website at www.systematic-investors.com. Please take a moment to visit and read through the disclaimers on our website. I know that's always fun, before considering use of our services. All traders and self-directed investors are always responsible for managing their own risk and making their own final decisions. So please use all information presented at your own risk. All right, so as Jay-Z says, men lie, women lie, numbers don't. So let's keep that in mind later when we go over the backtest results. So hey everyone, my name is Dave DeMarcantonio. For those that don't know me, I'll just cover a bit about myself. I'm a long-term student of the market since 2006, but I placed my first trades in the dot-com era when online brokerages started to become a thing. I'm an independent do-it-yourself investor in both financial markets and some commercial real estate. I ran a small trading room between 2011 and 2014, and many related weekend meetups for traders. I was a local Canadian Society of Technical Analysts chapter head. I ran monthly meetings for about 3 years, and I was 2 years on the board of the CSTA, on the board of directors of the CSTA. I network regularly with many different traders and investors, both long and short term, and I understand the struggles of short-term traders and longer-term investors quite well. So just another quick earnings disclaimer. As with anything, I think it's important to manage expectations. Trading and investing is not get rich quick, but you can do quite well over time. You benefit from treating trading or investing as a process. So it's a process towards building long-term success and wealth. It's what I would consider another stream of income. Everyone has big trades from time to time, but you can also have big losses. Not every trade's going to be a home run. You can't possibly know which ones will be big winners or which will lose. So you can't risk big on every single trade or you'll blow up. Don't get fooled by the hype out there. There's a lot of hype out there. Position sizing and risk management is paramount to longevity. So every presentation should have stated goals and objectives. Here are the goals and objectives of this webinar. So we're here to review the RSI strategy, this specific implementation. We're going to talk about the background. Where does the RSI-2 strategy fit on the trade spectrum? Some preconditions, implementation, rules and setup, and what do real trades look like? We're going to look at some of what real trades look like. We're going to review the backtest results to answer the question, does the strategy have a positive edge? Spoiler alert, yes it does. I wouldn't waste your time otherwise. How you can automate the strategy, and where you can find daily trade signals for the RSI-2 strategy. So a little bit of background. The basic RSI-2 strategy, the first time I heard about it, it was an idea popularized by Larry Connors and Cesar Alvarez. They're two great quant strat developers and idea generators. I also heard about the RSI strategy from a money manager friend that does regular presentations when I was running the CSTA chapter that I ran. He used a different variation of the RSI-2. So that kind of got me interested in the strategy. So the strategy idea focuses on a short-term oversold condition within the context of an uptrend, or a short-term overbought condition within the context of a downtrend. It fits within the what I would consider reversion to mean category of strategies, or the idea of buy the dip in an uptrend, or conversely sell the rip in a downtrend. So the strategy finds a short-term oversold condition in an uptrend. The expectation is that the uptrend will continue after the minor pullback, or after the oversold condition has completed. The RSI-2 strategy that Larry Connors discussed didn't really advocate using stops, to the best of my knowledge. So we do use stops. We take the approach of stopping out if the trending condition no longer exists, and using wide stops, mind you, but then compensating by way of portfolio-based position sizing, which simply means spreading risk using multiple portfolio positions. And we'll see what that looks like a little bit later. All right, so a robust trading plan benefits from the diverse characteristics of how markets work. Here's a visual that shows 3 different characteristics and types of strategies that can be used to balance out a systematic investor's entire portfolio. So from left to right, you can have a shorter term strategy that exploits the fact that markets pull back before they move higher. A midterm strategy that exploits the well-documented momentum phenomenon of the market. For example, you could have a monthly momentum rotation strategy, or other type of short to midterm momentum strategy. Finally, a longer term strategy that capitalizes on the momentum phenomenon further, and the fact that markets trend over long periods of time, typically in the longer term trend following category. So the RSI-2 strategy, at least in our strategy implementation, fits within the first category. It is a reversion to the mean type of system that is shorter term in trade duration. Now, we focus on long side trading only and not short side trading for this strategy. So you might ask why? Well, some stocks are hard to borrow short, and there's no guarantee of consistent fills when you're shorting. The market has a positive drift bias that goes up approximately 57% or more of the time. And when markets get volatile, some countries or exchanges have been known to ban short selling. It's actually very difficult to come up with the rules for a strategy that shorts and achieve consistently profitable results with decent constant exposure to the market. So you can have strategies that maybe will do well and take advantage when markets turn, but it's very difficult to implement a strategy where you're going to dedicate money to that strategy all the time and have it work efficiently and actually make money. So, and bull markets, as we know, last much longer than bear markets on average. So some preconditions of this strategy in our implementation, our trading universe is going to be the NASDAQ 100, current and past. So that means the 100 stocks that comprise the NASDAQ 100 index today, and the 100 stocks that comprise the NASDAQ 100 index in the past on any given trading day. Our maximum number of portfolio positions is going to be about 15. And this is what we meant by portfolio-based position sizing. So we're trading a portfolio of stocks, allowing up to 15 portfolio positions. For the total capital allocated to the strategy, each position is equal weighted 1/15 of the total portfolio allocation. So for example, if we were trading 15,000, we would have about 1,000 max per stock position. Now, the strategy uses a simple macro regime filter for market timing. The SPY has to be trading above its 95 EMA on a closing basis. So this market condition has to be true in order to allow any buy signals at all. Our signals are ranked. So in the case of too many signals versus the number of slots available in the portfolio, some signals are given priority over other signals based on a relative strength algo. The stronger stocks will be given higher ranking. So we don't disclose this algorithm, but generally speaking, stronger stocks are favored. Okay, so in terms of implementation, the RSI-2 strategy and our implementation is an end-of-day strategy. It does not use live market, intraday market data to make decisions. All decisions are made after the market closes. Execution takes place the next day. Entries are limit orders after open, so they'll be active until filled or canceled because they are day orders. They'll be canceled at the end of the day. And exits are market on close orders. So in other words, all sell rules wait for confirmation of closing prices and conditions at the end of the day for execution next day. So there's a one-day trade delay. So why do we do this? Well, because this allows for practical and realistic execution. There's no look-ahead bias or difficult to execute trades. So let me just take a quick drink here. Now, the buy rules, in terms of the buy rules, the RSI-2 is oversold and crosses below 15 on a closing basis. That's our pullback. We buy the next day at the previous day's closing price using a limit order. So we're not using a stretch factor or trying to buy at a discount from the previous closing price to maximize the expected ensuing snapback. We buy at the previous day's closing price. We place a limit order for that. Now, it has to be a constituent of the NASDAQ 100 index today. And for backtesting, it has to have been a constituent of the NASDAQ 100 at the time of purchase and not within 2 days of being delisted. Now, in terms of the sell rules for the profit target, we want to sell when the RSI-2 is overbought again. So the RSI-2 crosses above 88 on a closing basis. Now, the target is actually 90, but 88 allows us to get a little bit in front of 90. So 88 would appear to be an optimized parameter, but it actually works quite well in live market conditions. And we're going to sell the next day, market on close, as long as the sell condition has been met from the previous day. So for example, if we get a close above the RSI 88, let's say we close at RSI, the RSI-2 closes at 89 at the close of today, tomorrow we'll sell that position on the close of tomorrow. That's essentially how that works. So now our rules for stopping out, we want to stop out when, or we want to sell when the RSI-2 of an individual stock closes below its exponential moving average trend filter of 150. That's essentially what we use. So we're going to sell the next day, market on close, as long as the sell condition has been met from the previous day. So yes, I know some people might be wondering, sometimes the distance between the entry and a stop below the 150 EMA can be quite large. I'll show you an example of that later. But we want to be involved as long as the stock is still trending. We use portfolio position sizing to mitigate the overall risk of losses. So let's take a look at an example. This was a recent trade that my automated system took. We'll be talking a little bit about that later as well. So here's the RSI-2. It closed below 15 on this bar here. So we're going to be buying at the limit price of the previous bar. And you can see it dip below that at some point after the open. It got filled. And then we're going to sell on this bar. So the condition to sell was on this bar, and we actually sold on the close of this bar. So you can see in some cases you get, here's your sell signal on at the end of the day, and you get some continuation on some trades. Now some trades will do this and then you'll sell the next day lower, like this kind of situation, but many times you'll also get continuation and you'll get a better exit price. Okay, here's another example of a winner, Facebook. This was another trade we took. This was, we would have bought at a limit price of the low of this bar. We got in on this bar. You can see it didn't close below the 150 EMA. And then, like I said, we got a sell signal here, and you can see here it sold off a little bit. We still got out at a relatively decent profit. I think this was maybe about a 15% trade or something. I can't remember exactly, something like that. So as you can see, the RSI-2 is essentially a swing trade. So where you're attempting to capture a swing from a relative low to a relative high in the market. Now, it's not necessarily an absolute low or an absolute high. It still fits within the criteria of a reversion to mean style trade. Now let's take a look at a couple of losers. So this is a PEP. You can see here this was the entry, and you can see that it had a close below the 150 EMA filter, the trend filter. So because that indicates that essentially the stock may no longer be trending and it's time to get out. In this case, it was absolutely correct. So you can see here, here was your sell. You would have generated a sell here. You would have closed at the end of the day here, even though it popped back up. You could see that this was sort of indicating that the intermediate trend might have been over, and overall, it's time to get out of this stock. Now, here's an example worst case trade scenario for those that are wondering. I know myself, when I look at trades and strategies, I like to know, okay, well, what does a worst case scenario look like? So here it is. So this is why we adopt the position sizing approach that we do. This one bad trade didn't do a lot of damage to our account. While this specific trade had a 48% loss and the coronavirus sell-off was about 35% down, this strategy had about a 12% maximum drawdown during the same period of time. So even with this trade included. So aside from maximizing profits, we believe that managing risk and managing drawdowns should be one of the primary concerns as a systematic investor. Sure, the stock in the market eventually recovered, but not all stocks do recover, even if the market eventually does recover. So remember, some stocks go to single digits after having traded double or triple digits, and some even go to zero, okay? All right, so let's talk about some of the backtest assumptions. So our initial capital for a backtest is going to be about 100,000 account size. Again, 15 maximum positions, 1/15 equal weight per position. We're going to use our daily bars or our time frame, and we are essentially going to be backtesting from January the 1st until the present, so approximately 20 years. Again, our universe is the NASDAQ 100, current and past, using index constituents. And for the sake of this presentation, we're not going to use any commissions. All right, so I just want to talk a little bit about using portfolio approach. So a portfolio approach is used rather than just trading one instrument at a time. It assumes that when spots open up, the next available trade setup that's matched and ranked will potentially fill the available spot in the portfolio. Many different symbols are used. There's less chance to curve fit when using a portfolio approach versus using one symbol. It's more robust and it helps diversify risk. So portfolio backtest approximates what would have happened from the start date if trading proceeded in a continuous manner. It mimics real world conditions essentially. So a portfolio trading equals better risk management through position sizing, larger sample sizes, more opportunities, diversified risk, and it's more robust. For those of you that were on the recent webinar we put on, I mentioned one of the things that absolutely changed my approach to the markets was portfolio trading. Okay, so here are some of the key backtest metrics that we're going to look at. Excuse me. So the highlighted ones are the ones I tend to focus on, at least initially, when I first look at a backtest and I'm first evaluating the strategy. I especially focus on the max drawdown and the CAR MDD, or the MAR ratio. So obviously we want to know what the compounded annual return is. We look at the average profit divided by the average loss percentage, which is essentially our expectancy. So we see if we have a positive expectancy, we have a positive edge for the system, or we don't. I also look at the maximum drawdown, CAR MDD, the payoff ratio, and some of these other metrics. So let's see what that let's see what that looks like. So let me just stop this here. Okay, and let me just, oops. Hang on, gang. I actually just made a little boo-boo, and I need to open something up here. I just closed one of my tabs. Just bear with me one moment. Okay, sorry, gang. Just bear with me a moment here. I was not expecting to do that. Okay, let me just see here. Okay, so let's take a look at the first back test. So can everybody see? I can zoom in a little bit so everyone can see this okay. Okay. Okay, great. Okay, so here you can see we're starting with $100,000. Our ending capital is going to be just over 1.1 million. Now, if you look at our exposure, we're only in the market about 50% of the time. Now, our annual return is about just over 12%. But if you look at our risk-adjusted return, which takes into account our exposure, because we're only in the market about 50% of the time, our risk-adjusted return is pretty good at almost about 24%. Now, we've got a good sample size here. We've done almost 5,000 trades. Our expectancy, which I mentioned is one of the things that I like to look at, is about 0.82%. So what that means is between our winners and our losers, we're going to make almost 1% between our winners and our losers, which isn't bad. Our average bars held is going to be about 10. So you can see here we've got about a 62% win rate, which isn't bad. Our average profit is about 4.22% on our winning trades. Our winning trades are held about 9 bars. We have 29 max consecutive winners, which is pretty good. Excuse me. And the largest number of bars in our win is about 16. I don't worry about that too much. Now, let's take a look at our losses. So when we lose about almost 5% on a trade. So you can see this strategy works because we win more than we actually lose. Our max consecutive losses are about 17 in a row. And this is exactly why you need to position size, because you can have a string of losses. For those that have studied the concept of risk of ruin. Let's see, number of bars and largest loss is 11. Okay, so our maximum system drawdown in this example is about 31%. Now that seems really high, and I think most people can stomach a drawdown of about 10 to 20% in the real world. Once you start getting over 20%, a lot of people freak and bail. So I'm going to show you why this is a system that I'm still interested in, because it does have an outlier scenario that we'll cover next. So in this case, our CAR MDD is about 0.4. Now, before commissions, I like to see a CAR MDD of at least 0.5. In fact, I like to see a CAR MDD of about 0.5 or higher in order to consider trading it after commissions. Okay, so you can see here the payoff ratio is about 0.85, and that is determined because you can see here that we actually lose more than we win, but our win rate is higher, right? So we've got a payoff ratio below 1. All right, now we have some other stats in the system here, which we won't cover today, but I do want to show you. I want to show you the equity chart. The equity chart looks pretty good. You can see here it just hit some new equity highs recently. You can see the recent drawdowns. If you look, I could probably zoom this in a little bit. Let me just zoom it in a bit. You can see here we hit new equity highs recently. This was the coronavirus, this was the recent coronavirus sell-off. So you can see here, I think we had a drawdown of about 12%, which is not bad considering it was a quick drawdown. It was a quick sell-off, but it was, the NASDAQ was about, I think it was about 35% down. Okay. So, so that was, in relation to the actual market, it did pretty well. So if we look at the actual profit table, now, during the dot-com era, this is where we get this one massive drawdown. So if you look at this really kills our CAR MDD because of this one outlier drawdown during that crazy dot-com era, right? I don't know if any of you were trading during the dot-com era, but things got pretty crazy. And you can see here this one drawdown. It kind of, if we didn't look under the hood to see how the motor was running, we'd probably think, yeah, this CAR MDD, it doesn't fit my objective function, which is a subjective measure I use where I want to have a CAR MDD or a MAR ratio of about 0.5 or greater in order to consider trading the strategy. So if you don't look under the hood and you don't look into some of the specifics of your back test, you would probably write this off. But then you see here, it's this one big drawdown that kind of skewed things. And you can see over the 20 years, it was pretty much an outlier. If you look at the Monte Carlo results, I think it says, I'll just do that just really quickly. If you look at the Monte Carlo says that you have about a 5% chance of a 35% drawdown. Okay, so, the chance of actually having that size of a drawdown is actually quite low. Okay, so I don't want to really get into Monte Carlo today. I want to keep this a little bit more high level. But if you look at the profit table, you can see, yeah, we do have some losing years, but they're pretty, contained. And you can see here, like last year, I don't think we beat the market last year, but we did pretty good. And in most years, we will beat the market. This year, we're up a little bit. We're up a few percentage points. So, I like to see a lot of black years versus red years in the profit table, and I like to see a lot of black months. Here we don't have any red months on average, right? Any of the 12 months, they're all fairly positive. Okay, so having said that, so this is the back test from January of 2000. Guys, I see a couple questions coming across. I'll take a look at them at the end of the presentation. So if we look at what I did was I kind of fast forwarded the back test, and I started this back test from January 2001, right? And what that did was it got rid of the outlier. So you can see here that big outlier is gone, and we can get a sort of a different perspective on, is this a strategy that, of course, any strategy can have an outlier, but is this a strategy on average that we want to trade, right? We could take out that one big outlier. You can see here our maximum drawdown was about 14%. So if we look at the stats, we had about a 12% return. Our risk adjusted is still pretty high at about 23%. We've still got a lot of trades that went off. Our expectancy dropped a little bit, but it's still, it's still reasonable, almost 1% per trade on average between our winners and losers. A lot of these stats would have stayed the same or pretty close. We've got a 4% win versus a 4.5% loss. We've still got a 62% win rate on average. Now, if you look, our maximum system drawdown was about 14%. Now, that is within the realm of what most people can stomach. So this is why this is a strategy that we've included at Systematic Investors Group for our members. So you can see here our CAR MDD is a respectable 0.88, the modified CAR MDD, and our payoff ratio is still about 0.85, which is a result of losing more than we actually win on a percentage basis. So let's just take a quick look at our equity curve, still hitting new equity highs, maximum drawdown about 14%. We've got a lot of it's adjusted some of the returns. So you'll see that some of the returns are adjusted because it will depend on the start. Backtest always depend on the start date. Now you can also see there's many years that have, or many months rather, not years, that have 0%. So being a systematic investor requires some patience. You know, you don't want to trade when the market conditions aren't right. And you can see here our regime filter has kicked in, and it's taken us out of the market during these months where you see essentially 0% for the most part. So there were months where we just stayed out of the market. And you can see, let's see, in 2008, you had a string of months where, you know, during the GFC, the global financial crisis, where you essentially stayed out of the market as well. Okay, so that is our back test. We covered most of the issues with the back test. So let me just jump back to our presentation. Now, so as we've seen, this particular strategy falls into the higher win rate, lower payoff ratio category of results. So this isn't completely unexpected since it's a shorter term trading strategy. So, you know, I talk about the fact that you can have the reality when you backtest strategies or when you're looking for a strategy, you can have two types of strategies, right? You can have one where you're usually going to get, in terms of results, you're usually going to get a lower win rate, let's say 30 to 50% winners, but you're going to get a higher payoff ratio, right? Like, let's say 2 to 1, 3 to 1. You know, you're going to risk $1 to make $2. You're going to risk $1 to make $3 on average between all your trades. So this is more towards the trend following type of strategy in that slide that I showed at the beginning. And these are more towards, you know, the shorter term strategies. So, you know, you're going to win, in our case, about 62% of the time with a payoff ratio of about 0.85. Excuse me. So you can trade both strategies. You can trade strategies that exhibit both characteristics, rather, both types of results. It's just important to know what to expect, and it's important that you understand what kind of strategy you are trading. All right, so for those of you that are interested or already into trade automation to manage the day-to-day execution of your strategies, so myself and the team at Systematic Investors Group use Alera Portfolio Manager to manage our live trading. The trades aren't always exactly synced with backtest results, depending when the backtest starts and when your live trading starts, and due to other, you know, real live market condition factors. But typically, if you start your trading system after a period where your strategy gets you out of the market and then starts back up again, like in this instance with the coronavirus sell-off, trades will tend to sync up again. So like I said, a good example was the recent coronavirus sell-off. The strategy went 100% to cash, and it stopped trading for a little while, and then it started trading again when conditions improved. So everything synced up again. Now, let's take a look at the trades shown as open longs in my AMI broker backtesting software versus real positions I had on that were being managed by Alera Portfolio Manager and trading the strategy live with real money. So this was a screenshot that I took as of last Friday, July the 3rd. So we'll see that they're very close on a percentage basis, which is what you would hope to see and what you would expect. And in this example, it appears that only one trade was different in my backtest versus my real live trading. So out of 9 positions, the only difference was that I was holding AMAT, this position here. It looks like I was up almost about 5%. And the backtest was holding DXCM. So you can see here, I've tried to put them in order, and you can see, you know, the results at the time of the screenshot were fairly similar. Facebook actually just closed out today. I don't think I showed that. Let me just show that trade quickly. And to do that, let me bring over AMI Broker. So this isn't gonna, I don't think this is gonna have the end of day data for today. So here was the Facebook trade where it got in on this day. Yeah, and it would have gotten out, it would have just gotten out today. So this is, well, it got a sell signal, and it actually did physically get out of the position today, and I know that because I was watching it. So here's an example of the perfect kind of trade that you would want to see. You know, market's always stair-stepping when they're trending, and you want to buy that pullback, and you want to get, you know, you want to get that that move higher. So for those that are interested in, oops, sorry, gang. So for those that are interested in trade automation, this is a, you know, kind of a good example to look at the back test versus the reality. So if you guys want, you can test drive this same exact strategy for free using our strategy scans plus a paper trading version of Alera Portfolio Manager. To find out how, visit the link here. I mentioned I promised I wouldn't do a lot of selling at this webinar, but I just want to give you an opportunity to test drive this at no cost. So to find out how, visit the highlighted link here at systematic-investors.com/APM-integration. That's a mouthful. The videos on this page will walk you through the exact steps of how you can set up this strategy. It's super cool how this all works, and it won't cost you a thing to try it. Does everybody have that link? Okay. Okay, so having spent so much time over the past 14 years with other do-it-yourself traders and investors, I'm pretty much now convinced for myself and for others that most will never succeed without their own systematic strategies, such as the one we just covered, plus their own systematic process. So it doesn't matter if you are interested in our strategies or not. I recommend to any traders that I help mentor or that, you know, I just speak with on a casual basis, you know, do you have trading rules? Do you have a system? Do you have a process? Do you know when to get in and when to get out in a way that will keep you as process driven as possible and as unemotional as possible? That's always one of the first things I ask. So quant and algo is just another name for systematic investment. Here are some of the people and firms that employ their own systematic approaches. Okay, guys, so here's where I'm going to do a little bit of selling and then I'm going to stop. Okay, so just imagine what things could be like tomorrow if you just had the right systematic strategies working for you, if you knew what to expect from your trading, if you had a process that was taking the right trades for you day in and day out without you having to sweat or suffer from analysis paralysis or second guess whether you're making the right decisions. Instead, it was just putting in the required work day in and day out for you. How stress-free and easy would that make your investing life? I'm going to let you guys think about that for 1 second as I let my dog out of my office. Go ahead, buddy. Okay. Okay, guys, so before we get into questions, here's the link to access the free strategy scans. If you don't already have a free account, you'll need to set one up. I would also like to encourage those that are interested in systematic strategies to sign up for our low-risk 2-week trial of Systematic Investors Group for only $14.99. You know, you can try it out. You can check out our stuff. If you don't like it after 2 weeks, you know, no hard feelings. So if you think of any questions afterwards, you can also email me at the email address as shown. Okay, guys, so I'm happy to take any and all questions. Let me also turn on Dan's mic so he can participate as well. Excuse me. If anyone else would rather ask their questions instead of type them in the chat box, just type Mike in the chat box, M-I-C, and when we get to your question, I'll try and turn your mic on. Okay, now I'll just go to the chat box and see what we've got here. Hi, Ivan. So Ivan says, Dave, do you know your average fill rate compared to trades placed, i.e. 10%, 20%? Not all trades get filled. Well, we can see from the exposure that we've got about 52% exposure. I'm not sure. I haven't actually tracked in real time how many trades do not actually get filled. That's actually something I should probably take a look at. But I was more interested in just knowing what my exposure was. So I know it's only in the market about 50% of the time. I hope that answers your question, Ivan. Ivor says, hi, Dave. I came in a couple of minutes late and missed the system rules, including your regime filter. Could you please re-show the slide showing the system rules in the regime setup? Sure. This is also being recorded, but let me just jump back to that quickly. Let's see here. So just go through the rules quickly. Okay, so the regime filter, the SPY has to be above its 95 EMA on a closing basis. I do actually have this memorized, but you know, I'll just show the slides as well. So it has to be above its 95 EMA. That's the actual SPY. In terms of the implementation, it's an end of day system, so we wait for the closing prices of everything. Our buy rule is the RSI has to be oversold. It has to close below 15 on a closing basis. That's our pullback. We're going to buy at the previous day's closing price using a limit order. We're not using any kind of stretch factor. We're going to target out when the RSI crosses above the 88 on a closing basis. And again, the target is actually 90, but we get a little bit in front of that. And then we're going to sell the next day market on close when that condition on the previous day has been met. We're going to stop out when the RSI-2 closes below its 150-day exponential moving average. That's the individual stock filter. So any individual stock we're trading, if it closes below its 150 EMA, it's a goner the next day. Let's see here. There was a couple of examples. Oh, I showed you this in ME Broker, and I actually had it in the slide. Apologize for that. Ivor, here was a couple of losing trades. This is what a few losing trades look like. Here was a close below the 150 EMA, and here was like a worst case, 50%, almost 48% drawdown on one position, which is why we position size accordingly. Okay, I hope that answers. I hope that answers your question. Also, we're using 15 positions. Our universe is the NASDAQ 100 current and past, and we weren't using any commissions for this. Now, I think I missed a slide here, guys. So let me just, I did. Okay, so I apologize for that. So what I wanted to say is, so as we move forward and we showcase a few more systematic strategies that we have available over the next few weeks, we're probably going to do our next strategy session in a week or two. The next step after that will be showing how we can combine a few strategies to complement each other, reduce overall drawdowns, and smooth things out a little bit more. So stay tuned for that as well. Okay, so let's see. So Joe says, hi, Joe. Have you tried any other indicators for short-term buying the dip mean reversion systems? Absolutely. Absolutely, and we'll definitely talk more about that. We have some other ideas on how to characterize or how to define reversion systems, and we'll be Joe. You're a member at Systematic Investors Group, so we'll be discussing that on the inside. Ivor says thanks. Thank you, Ivor. Let's see. Marcel says, Dave, excellent presentation as usual. Thanks, Marcel. I really miss seeing you and all the guys. Absolutely, I do too. I can't wait till this is over, and you can take your long drives to Oakville. Absolutely. Yeah, and it's definitely worth having you, Marcel. I appreciate it. Let's see. So Joe says, have you tried trading the Asian or Australian stock market sessions in addition to the US session? Actually, Joe, I have not. I'm at this point in time, as an individual do-it-yourself retail trader, I'm not really interested in trading the Asian or the Australian market. The Australian market is the one that interests me the most. So I'm in Canada, and I don't even trade the Canadian market at this time. And the reason that I really don't is because, well, I can't say I don't. I sold a bunch of puts on Canadian banks last month, but that was outside of my systematic portfolio. But for my systematic stuff, I really want to have clean data And Norgate is the one that you want to deal with for clean data, for delisted stocks, historical index constituents, and because of that, I like to work with a data provider like Norgate that has that data. Now they do have data for the Australian market, and at some point, I may decide to do that, but at this time, I don't do it. But it's always good to diversify into different markets. Okay, so Ivan says, Dave, with all these strats running in APM, how do you use to track individual strat performance? Excel. So what I do, Ivan, is I just look at the backtest results every month. And because I've got all my strategies in AMI Broker, I can go back and I can change the start dates, and I can see how they're performing on a month-by-month basis. And I can, you can also do that on the Systematic Investors Group website. You can look at how the strategies are performing. It's very difficult in the brokerage account to break out your actual strategies. And because Alera Portfolio Manager, I had this discussion with them at one point, and realistically, they pull all the accurate data from your brokerage account to get all the stats. And if you lose sync, let's say you forget to turn the Alera Portfolio Manager on for a couple of days, or you stop trading a strategy, it's not going to know really how to sync that up properly in terms of it will in terms of real life trading, but it won't necessarily in terms of your strategy results. So they've just decided for that reason not to include a less than optimal sort of implementation of that. Now, I know a lot of people are interested in it, and you may be able to bother the developers at Alera and see if they can come up with something, but they had a pretty compelling and pretty convincing argument why it wasn't a good idea, and why it's probably better just to look at your overall performance in your backtest to get an idea of what's performing and what's not. And we may revisit that in the future as well. So Joe says, thanks. Thank you, Joe. It seems like we haven't talked for a couple of hours, right? Okay, Ivan says, I'm from Australia. I can tell you it's a struggle here because of the small market. Many systems won't get enough fills. Absolutely, Ivan. And I mean, we have the exact same issue in Canada. I think our markets are fairly similar. Although somebody told me the Canadian market is actually bigger than the Australian market, which I found hard to believe. But the US market is, generally speaking, 10 or 11 times the size of the Canadian market. The liquidity and depth, the volume is just so much greater. The only problem with trading different markets, I find, is the currency risk, right? You've got to take into account the fact that currencies are going to move for you and against you in your trading, and so you're dealing with currency risk all the time. But like if you maintain some money in a U.S. account, especially if you got that money at par years ago, it's great to have the reserve currency of the world in your account and be able to trade such a vast and liquid market. The U.S. market, I find, is really just the best. Okay, I'm trialing Trading Diary Pro. You can pull activity statements automatically from IB and tag individual trades with a strat name. That's interesting. Maybe one of the questions for the team at Alera will be, can we tag the real live trades with the different strategy names, and can we, kind of keep them separate in some way? That'll be an interesting question to ask the guys there. And I'll make a note of that and I'll do that. So Jim, hi Jim, miss seeing you too. So Jim says, thanks Dave, excellent presentation, much appreciated. Thanks Jim. I miss seeing all you guys at the meetings in Oakville. So as I mentioned, guys, I do network with a lot of different traders and investors. And some of us meet in close to my local town here. I'm from Burlington, and we meet in Oakville, which is the next town or city over, once a month when the coronavirus isn't messing up our plans. So gang, I'm not sure how long we've been going for. I think we're about 50 minutes here. So I actually exceeded the hour. I beat the hour time that I thought it would take. And for those that were on the webinar, a couple weeks ago. You probably appreciate that because we went for about 3 hours. So that's great. So does anybody have any other questions? Questions, comments? I'll leave the chat roll running for a couple of minutes in case you do. Okay, Ivor says, thanks, Dave. Thank you for attending, Ivor. Thank you very much. Okay, gang. So listen, you guys could have been anywhere tonight, especially on this beautiful Thursday night. You could have been anywhere, but you chose to be with us, and I really appreciate that. Oh, okay, another question. So Richard says, have you tried a maximum day stop? I personally have not tried a portfolio-based maximum day stop. It's something that we've actually discussed quite a bit in the various groups I belong to. I tend to develop strategies a certain way, so that's not something I've tried, but you could easily implement that using AMI Broker. You definitely could. Now, this is one strategy implementation, Richard, that we've come up with. I'm actually trading this live in my own account. It's one of the free strategies that we offer. We're going to be coming out with many more strategies going forward. And, you know, for our members that are part of the Systematic Investors Group, we can talk about different strategies. We've got several strategy developers that are looking at stuff. We can develop stuff. The community can contribute stuff. It can go through a peer review process. And for the ones that make the cut and that are, you know, what we all consider good enough, the core team at Systematic Investors Group, if the core team believes the strategy is good enough, we will take that strategy and we'll implement it for our members so that they can get the signals and trade it live without having to have, you know, all of the infrastructure to do that. We'll set that up for them. So that's something that we do on the inside. Lyle, hi Lyle, how's it going? We haven't seen you in a while. Not that we see you because you're all the way out in Vancouver. Thanks for popping by. Really appreciate it. And I hope everything's going well out there in Van. Rakesh says, thank you for the presentation. Thanks for joining us, Rakesh. Okay, gang, so I'll leave the chat going for another minute or two. And if there's nothing else, then we'll close off the presentation. For those that may be rolled in a little bit late, I'll send out a recording of this presentation. I'll make it available so that you can review it again. Like I said, you know, check it out. Check out the signals on our website. You can get the strategy signals every single day. They're free. Feel free to check it out. There's some instructions there for even just setting up a paper trading account so that you can automate it and just let it, you know, just watch it in your paper trading account every day and just, you know, see how the strategy looks, see how it feels, and take it from there, guys. Okay, thank you, Marcel. Thank you, Graham. I hope everything's well. Everything's going well. Okay, gang, so I'm going to shut this down. I appreciate, like I said, I appreciate you all attending. Stay tuned. We're going to have another strategy session in another week or two. I want to space them out a little bit. The next strategy that we're going to cover in our strategy session is called the supercharged momentum trend. Now, I personally trade both of these strategies together, and the reason why is because the RSI-2 strategy is basically a pullback strategy, and the supercharged momentum trend is a strategy that is based on short-term momentum. So they complement each other quite well. So stay tuned for the announcement of that. And we also are going to be announcing, we just added another strategy from one of our amazing contributors on our website from our community. It's called the narrow pullback. We're going to be announcing that early next week. So stay tuned for that as well. We're already generating signals and beta testing that strategy as well. Okay, great. Thank you, Ivan. Appreciate it. So gang, like I said, you could have been anywhere tonight. You chose to be with us. I really appreciate it. I'll look forward to seeing you either on the inside if you decide to take a trial, or I'll look forward to seeing you at the next strategy update. All the best, guys.